Hello everybody and welcome to the Like a Tortoise channel. Today I'm recording a special video and I intend to address one of your comments not that long ago, in fact 6 days ago. Why to Woody7 commented, could you do an analysis on Align Technology, Align Technology Inc. And the reason I'm doing this is number one, because this is a sign of appreciation as a way of me to say thank you for commenting, for smashing the like button. And number two, the company fits a lot of the criteria that I would deem as high quality. And for that reason, because it ticks some of the boxes, I want to take time to delve deeper into the company throughout this video, and I do hope you guys find it insightful. And if you do, don't forget to smash the like button and to share it with your friends and relatives, because it really helps the channel. And if you have any more ideas in terms of companies that fit the high quality criteria that I'm after, then by all means leave a comment and I will look into it. Okay. So without further ado, let's talk about Align Technology Inc. And I noticed that this company, the sector is the healthcare. And healthcare, for those of you who don't know, is at one of its relative, in fact, it's at its lowest relative PE valuation since the great financial crisis. So you have to go all the way back to 2008 to 2009 to see the whole sector in as much pain. So why is that? Okay, that's the thing. And do we find any attractive opportunities given the relatively low valuation levels? So that's the question. And I can see, for example, that within healthcare, the Align Technologies, according to stock analysis, is within the medical instruments and supplies industry. And this industry has a PE of about 53 times, while Align Technology has a PE of about 21.69 times. So there's a big discrepancy here. And what's more, you can see that the company trades at a very low forward PE. So on a PE ratio basis, the company may be undervalued. And now we have to determine whether this is a value trap or if it's something that interests us more as long-term investors. If it's something that has a lot of quality, but the market is not reflecting that fundamental robustness. Okay, so let's delve deeper into the company then, and let's see what answers we can dig out. And the first thing that I want to know is if this is a high quality company that is trading on the cheap, then it might have become a turnaround play. If it's a turnaround play, right? So then what I want to see before making any investment is I want to see an improvement in terms of margins, right? So gross margin, operating margins, net margins. I want to see capital allocation improvement, ROIs, for example, right? And I want to see that the company is back into growth mode. So revenues are growing, earnings are growing. So because some of these turnaround plays will take a very long time to play out. And to account for that, you should understand whether the fundamentals are improving, and in which case the company will be able to turn around faster. Okay, that's what we want to see. I'm not sure if this falls into the category of a turnaround play, but we'll see. So what do they do? Let's have a look. And this is the first time that I'm doing this analysis. I've never heard of this company before until I read that comment. But I can see that they provide Invisalign clear aligners, Vivero retainers, and intraoral scanners and services in the United States, Switzerland, and internationally. The company's clear aligner segment offers, I don't have any idea what this means. And that's one of the reasons why I try to avoid healthcare. It's just, number one, the industry doesn't interest me as much, and so I'm not really interested in delving deeper into many of these companies, even though they can be very cheap, because I don't feel I have an edge, and I don't have an edge, and I'm a bit bored, frankly. I mean, I'm not really interested in these things. And if you are going to be a long-term investor and if you are going to commit yourself to doing the work, right, to checking in with your companies every now and then, especially when they report earnings, you'd better make sure that you are really interested in what they are offering. Okay, so that applies to the person, of course, who left the comment. If you have an insights into the industry, then I think you are already ahead of the competition, and maybe you know something that I don't. Okay, but what I will be doing here is going through the financials and tell you what I think about the company from a financial standpoint. But this is important because even though the financials might be great, right? They tell you only part of the story. They don't tell you whether the company has a strong moat or a narrow moat or a weak moat or no moat at all. In fact, well, some metrics like ROIs, for example, if the company has achieved ROIs of 15-20% over many years, then of course that is the sign of a moat. The same happens with growth rates and all of that, but you have to delve deeper. All right. So going to the income statement, I can see that total revenues, they have been pretty much stagnant since 2021. All right, after a period of exuberance, in fact not exuberance, after a period of significant explosion back until 2021. Then the company, so it traded a bit lower. Now it's on the way up again. This is positive, and you can see that the CAGR ever since 2020-14 is 18%. So revenues have been growing at 18% per year compounded, which is pretty significant. Okay, there's a lot of demand for what they are doing, for their products or services. So that's something that I like. What it's not good, it's to see that revenues are a bit stagnant since 2021. But what I also like to see is that they crashed here. They came back down in 2022, probably some normalization after COVID. And now they are once again back on the way up. So this is positive, a positive development here. If I try to look at the quarter screen, then it's a bit bumpy, but you can see that they seem to be on the way up once again ever since 2022, which is a positive. Okay, and I like the growth rate as well. Now let's talk about net income, which is revenue minus all expenses. And you can see that over the same time since 2014, net income has grown at about 12% per year. Much slower growth compared to revenue, but still above my threshold, my preferred threshold of 10% per year. And if I shrink this, and let's do this for the last 5 years. Okay, since 2020, here we go. It was even negative at one point. If I go here, so I can see that the CAGR was negative. It has been negative since 2020, right? So since 2020, look at that. The CAGR was negative, minus 37%. Something happened here in 2020. I think this had something to do with COVID, but this was definitely an outlier. So if we strip that out, of course, we wouldn't have this negative minus 37%. But White Woody, make sure that you understand why this spike occurred and why net income has come in pretty sharply. All right, but I like to see, for example, that things seem to be on the way up once again. And if I change this to the yearly, you can see that since 2022, net income has been going up. In fact, it went up in 2023, now seems to be declining a bit. So we have to understand what's happening here and why the company hasn't continued to increase the net income. And in fact, because I don't know the business, remember? So I don't know why we saw that spike. But for example, operating expenses have remained the same. So nothing significant here. Probably, what else do we have here? Interest expense. We have SG&A. Yeah, okay. So these are part of the operating expenses. I don't see anything unusual here. It's just net income that took a beating. So make sure you understand why that is. All right, but this is all I can say from the income statement. And also, hold on, let's have a look. So the company, what's important here with some of these companies is that I like the fact that they are profitable. And if you are going to invest in a company that is not profitable, you'd better understand the company very well, because that's really very risky, in my opinion. I only like to invest in well-established companies that have already proved themselves, right? So let's check the balance sheet, and we can see that in terms of assets, they have been going up since 2009, and so the medium is about, the average is 5.52. So the assets, let me flip this to the yearly chart, and you can see that the assets have been increasing as well. Since 2009, they have increased at about 20% per year, which is good. They are somewhat stagnant right now, but still slightly increasing, which I like to see. Let's check current assets. Same thing. And what about total cash? Okay, so this is good. So they have about 1 billion in cash. What about debt? No short-term debt, no long-term debt. Okay, so they have a net cash position. Let me confirm that. Balance sheet. Yes, I can see they have net cash per share of about $10.73. Net cash of almost 800 million. I like to see that, right? So this is a pristine balance sheet. You can see the cash and cash equivalents are far greater than the total debt, which is fantastic. Probably because this is a low capex, capital intensive company, but I will be able to determine that later on. In fact, what about, let's check that now. Capex. Yeah, so this is how much they are spending, about 99.53 million out of all of this operating cash flow. So they are not spending that much money to maintain the operations and to grow the business. And so capex is low. Maybe they don't have to spend as much to grow the business, okay? Because it can be quite scalable. In which case, this is good. They are operating an attractive business model. No debt, I like that. Liabilities at about 2.4 billion, but we can see that total assets are greater than current liabilities. So the debt to equity is very attractive. And book value, of course, is also very attractive here. What's the book value per share? That's about 53.98. Very good. So this company is definitely trading cheaper because they are a capital light company, so it seems, and the book value per share is about 53.98, and the stock price is about double the book value. So it's definitely, yeah, exactly. Look, the price to book value, ideally, to be a value play, it would need to be below one, but that doesn't happen in this market, right? It's so expensive. And besides, if the company is capital light, that means that they don't have that many fixed assets, right? So they have more intangible assets, in which case the book value is not really relevant. But something to keep in mind. Okay, so balance sheet seems to be attractive with no debt, as I mentioned, book value growing, even though things have remained stagnant across the board ever since 2021. And this is important. Again, understand the reason for this. Why has the company gone nowhere since 2021? And that coincides with the crash that we saw, right? Because if I go here to the charts, I can see that the company went ballistic in 2021, but then it crashed sharply. Yeah. Now and that coincides with some of these things being stagnant. And if this is a turnaround play, you want to make sure that whatever it is the company is doing right now is going to be able to grow those revenues in earnings, in the book value per share. Okay, and I'm not seeing that right now. So watch out for that. If I go to cash flow, cash from operating activities, let's see, it's going down since 2021, much lower right now. Okay, I don't like that. Yes, look at this. This is a big crash, even from 2024, not that long ago. So I don't know why this is. Why are they doing? This comes on the back of lower net income. Let's check. Maybe lower net income wasn't exactly the main reason, but so you have to understand why that's happening and if it's something that is going to change, because ultimately we want the business to be growing organically. All right. So if the business operations are throwing out a lot of cash, that's a big positive. But when you see a deceleration like this, it can be for many reasons, and management will definitely cover it in the annual, in the annual reports and the quarterly reports as well. Stock-based compensation, I don't like to see that. So we can see that the company has been declining across all metrics. However, what I can also see is that stock-based compensation continues to go higher and higher regardless. And because this means that the percentage of stock-based compensation relative to cash from operating activities is going much higher. Why? Because stock-based compensation is increasing while cash from operating activities is declining. I don't see that. I don't like that. Okay, so you have to understand again if what management says about stock-based compensation and why they are doing more stock-based compensation, as the fundamentals seem to be deteriorating slightly. Now, let's have a look at cash from financing. So investments in property, plant, and equipment. So since 2021, they decreased investment substantially. This is capex. Okay, so the company has decreased how much money they are spending to grow the business. Is that a negative? Is that a positive? I don't really know. It depends. Because I don't know the business. Just bear in mind that if to have some level of spending is important. So why are they decreasing this spending sharply? Again, you have to be able to understand that, because this is something that the financials don't tell me. And then the free cash flow, of course, at the end of the day, free cash flow is what matters the most. And I can see that free cash flow is went up since 2023. And if I go back all the way to 2014, I can see that the levels of free cash flow are among the highest they've been, which is good, right? So the company is producing a lot of cash, and this is certainly a positive. And if I go here to insights, I can see that the overall score is about 3.83 out of 5. Something they don't like, for example, in terms of management, is the share-based compensation as a percentage of operating cash flow, for 24%, and the free cash flow to almost 30%. So why is the company not putting up more of that cash flow into growth? They are decreasing capex, but they are accelerating share-based compensation. I understand some level of share-based compensation because you need to attract and retain talent, but when the fundamentals are deteriorating, I don't like that. Okay? Profitability, that's okay. So growth, financial health seems to be pretty good. As I mentioned, the balance sheet is sound. They are debt free. Shares are decreasing, are they? Let's have a look. I forgot to cover that. This is very important because if they are doing stock-based compensation, we want to see that that is not increasing the amount of shares outstanding. So if I go here to the income statement, this is the yearly chart, diluted shares outstanding. Okay, so they have been decreasing since 2024. That's good. And let's see if they are ramping up buybacks now that the stock is even cheaper. So if I go here to ever since 2021, let me see. Yeah, look at that. So they were buying a ton of stock. Okay, so in 2021, when the company was trading, in all likelihood, at nosebleed levels, they were still doing buybacks at about the same rate that they are doing right now. That the company is trading at a much lower price. Okay, and And so now it should be the other way around, right? So this now that the company is trading at much lower valuation levels, this is when buybacks, this is when the diluted shares outstanding should be decreasing the most. Okay, and you can see that since 2020, the decrease has been pretty much insignificant, in my opinion, considering how much the company has crashed from its all-time highs. So if I go to cash flows and to net common stock issued, yeah, exactly. Look at this. 2021, this is how much they spent on buybacks, 349 billion with the stock at all-time highs. And now, 2024, 327. Okay, so this does not make any sense to me, even though they already they were much higher in 2023. But yeah, it's what it is. Uh, let's go back to our insights. And that's it. And what about analysts? So analysts, if I go to stock and lock, let me clear that. I can see that the analysts are projecting earnings per share growth of about 22.84%. So they are pretty bullish long term. And if I go here to FinChat to check the long term projections, FinChat, PayPal, let's go here. Sorry. Let me get rid of this. FinChat. Come on, why is this not? FinChat. I should be able to see that. FinChat AI. Typically, it will give me the site right here. Okay, good. It came up. So now if I come here and put a line, let's put a line technology right here. Let's go to overview. The earnings per share for over 2 years is about 8%, according to these analysts, and then the earnings per share long-term growth estimates is negative. So this will not serve us. So we're going to use our 22.84% as the analysts for the analyst assumptions. So analysts, let's assume that because now I discussed the fundamentals. Okay, so now the question is whether the company is cheap or not. And I think we can do instead of running through every single one of our valuation methods, I can just, because this is a high growth company, I can just do the margin of safety, and you can see that the earnings per share right now sit at 5.29, and you can see that analysts are projecting 22% growth over the next 5 years. Now I want to be very conservative. I don't know what can happen, so I'm going to be using 30. I'm going to be using 15% for future growth. I'm going to assume that earnings per share are going to grow at 15% over the next 10 years. And I will assume a P multiple at the end of that period of about 30, which is double the PE. And so if I do that, okay, if I go here to our compound annual growth calculator, and if I do quick valuation right here, let's project 15% growth over 10 years. That means that the estimated earnings per share in 10 years will be about 24. Okay, and then if we multiply 24 by double the growth rate, which is 15%, then we get 30, and that means a future price per share of about 720. So if the company can grow earnings per share at least 15% over the next 10 years, and remember, I'm being very conservative here, okay, but I never use figures above 15% exactly because I'm conservative. and we always know that analysts tend to be ultra bullish most of the time. So now that means that the future price of the company will be around 720. We have to discount this to present, and because I went 15% per year, you can always divide. You can just divide this by 4, all right? Because in 10 years, to double your money every 5 years, you need 15% annualized returns. So that means you have two doubles in 10 years. So 720 divided by 4, that means we have an intrinsic value of 180. We never pay intrinsic value. Okay, you want to buy it with a 50% margin of safety. So 120 divided by 2, that means the price you should pay is around $90 per share, and the company is current at 128. So on a margin, this is, I think, I don't know the business, but we can make the case that the company is already trading very cheaply. Okay, per our very conservative assumptions, the intrinsic value is about $180 per share. Even if you buy it with a 50% margin of safety, then that's about $90 per share. And in my opinion, if I knew the business very well, if it checked all the boxes, I would be glad to start a position around this level. Of course, I'm not going to do that, right? Because I don't know whether the company has a moat, and that is essential. Valuation means little if the company doesn't have a moat well, if the company doesn't have a moat to protect it from competition. But from a valuation standpoint, this already looks pretty attractive at these valuation levels, and that it goes the same for the relative valuation metrics that we use. So I can see if I go to statistics, for example, price to free cash flow of 14 times. In fact, let me show you this here. If I go to our free form here on Stock and Lock, this is also pretty cool. Look at that. So let me get rid of this, and let's use price to free cash flows. Let's use price to earnings, and let's use price to free cash flow. And look at that. So if we go back all the way to 2014, you can see that the company right now is trading at one of its lowest valuation levels ever across this in both metrics. Price to free cash flow right now sits at 14 times. The lowest point was 14.33, so we are practically at the same levels. And from a price to earnings ratio, the lowest was actually in 2020, and that was right here after that big crash. Right, we get to a very low P of 8, but you can see the median is about 40 and the average is about 47, and right now we are 21. So we are at one of the lowest valuations ever. Okay, so look, this is all I can say. Personally, I wouldn't invest in the company, as you already determined, because I don't have any edge. I don't understand healthcare. I'm not interested in the industry. Maybe in the future I will be, but yeah. So I think a few red flags here. The fact that the company has remained stagnant across many of its financial metrics ever since 2021. And that can be a reason why investors have turned more bearish towards the company. But from a valuation standpoint, it ticks the box. Okay, you would have a big margin of safety even under conservative assumptions. Now you just have to determine if it has a moat, in which case you will be you can be onto something here. Okay, and also if I go here to interactive brokers, I can see that Morningstar rates the company so they rate the company very good, right? So they say the company has an economic moat, even though it's narrow. It's still a moat. So there is weak moats, narrow moats, and then wide moats. This one has a narrow moat. The Morningstar rating is pretty good, as you can see. They even say the moat trend is stable, even though there is high uncertainty. And you can see, voila, that the fair value estimate is about $220 per share, which, to be fair, is not far from our reasonable conservative assumptions and intrinsic value assumptions of 180. It's pretty much in line. Okay, so it looks like both Morningstar and myself are in accordance. Yeah, I do hope you find this insightful. I hope it helps you along your journey. If it does, just let me know in the comments, because I want to know if I need to improve anything. And yeah, just let me know. And if you want more videos of this kind, by all means, continue to smash the like button and leave your comments. Thank you so much, guys, and have a great rest of your day.